Hi everyone and welcome to the Aussie Expat podcast. Today we are bringing you a very special episode. It's the Thursday after the recent budget announcements. I've got the absolute tax guru extraordinaire Tristan Perry with me today to help us break down all the, what do we say? All of the
tax tidbits,
Let's call it that. All of the conversational points that have come up, maybe some of the controversies that are out there at the moment. This is, you and I have been friends for a long time, Tristan. Yep. This is normally your kind of Christmas in May.
Yeah, we've had a few boring budgets in the last few years. So this one, suddenly, there's lots to talk about again.
This one has definitely caused a reaction. It's caused a lot more talk than usual than we've had the last few years. Yeah. It's good to have you here because there's a lot of people asking a lot of questions. There's a lot of, I wouldn't say they're misnomers yet, but a lot of things that people are just wondering, how's this going to impact me? What does this actually look like in practicality? The devil is always in the detail with a lot of these changes as well. So what I want to spend some time on is what I call the top three initially. It's the three that everyone are asking the most questions about, which are the negative gearing changes, the capital gains changes, and then the trust changes Spot on. And then at the end, we might talk about some more general... Some
of the broader ones that they like to do. Yeah, exactly.
But maybe be good to get your initial thoughts, overall summary.
Yeah, overall summary. Okay, so like it's obviously it's a government that needs money, surprise, surprise. And, they've had a big focus on increasing housing stock for new home buyers. So that's kind of the underlying, reason for all these changes, which the government are sort of holding on to. So, if we talk about the capital gains tax one first, it applies to all asset classes. That's really important, not just property, but a lot of Australians own property, so that is being talked about a lot. But
it's the one I'm seeing in the headlines the most at the moment.
Capital gains. So it's and look, initially before I get into the detail of that one, the changes to capital gains tax do apply for expats. So before, expats missed out on the 50% capital gains tax discount. As far as we can see, and that's my little disclaimer there, as far as we can see, they're going to benefit from, expats will benefit from the indexation method. So, before we had no capital gains tax benefits, now we've got something. So, from 1 July 2027, the negative gearing changes, that's obviously a big one. They've kept negative gearing for new builds. Importantly, a new build is a newly constructed dwelling that wasn't there before, so you can't do a knockdown rebuild. Just to, with some FIRB approvals, you could do a knockdown rebuild. So that's just make sure that those rules don't get confused. And obviously, discretionary trusts as well, which is, they are used in expat land, but not as much. I know, Tim, you can sometimes have dramas getting loans for them, or the loan options are limited. But we've now got that 30% permanent withholding tax applied to trust distributions. Lots. Each area you can unpack it a bit.
Yes. We'll talk about it in a moment. I'm keen to get into the detail and probably work out some different scenarios for people to help really understand what it means. Quick disclaimer to everyone. Like I said, this is the Thursday after the budget. The actual legislation is not out yet. The specific criteria are not legislated yet. So we are doing our best to extrapolate from the information that's there. But it's going to be an interesting few weeks ahead because I think there's already a bit of noise in the media atmosphere. It'll be interesting to see what actually lands in the next few weeks too.
Treasurer copped a beating.
Yes.
Treasurer Nalbo, wow. Anyway, it's so look,
maybe we'll start with capital gains.
Capital gains, the big one.
Because that's the one I'm getting the most questions about. So maybe let's specifically talk about...
As am I.
Yes. So maybe talk about the specific changes first, and then we'll kind of go through a couple of different scenarios that people are wanting to understand a bit more.
Okay. So the main change, and from the outset I said it before, this applies to all asset classes. So property, shares, crypto, precious metals, managed funds, etc. So just that.
And the one that's getting the most noise is small business sales in Australia.
Small business, and that's a complicated one actually. So small business sales is a complicated one because the concessions for small business are quite major, but we won't go and get into those because it's going to be quite technical discussion. So from an actual, what's changed?
Yes.
So So basically, they're phasing out the 50% capital gains tax discount from 1 July 2027.
Sure.
So that's the major change. Now, non-residents didn't get it anyway, right? So we missed out on the 50%. That was the rule change that happened in May 2012.
Yes.
So normally when we're looking at clients' property CGT calculations, we normally need a valuation or need to adjust for that period.
Yes.
So what I was saying before is that the new method, which will be indexation method, which is originally around from 1999. I think it's like a Keating
era.
Yeah. So the indexation method, basically what that does is that uses the CPI adjustments to effectively uplift the cost base and the sell price by CPI. Also, uplift the cost base using a calculation with the sale price and the time of the sale and the time of the purchase, which effectively gives you a higher cost base, which you then pay tax on. And capital gains tax calculation is always at your marginal rates in the year that it incurs. So as a non-resident, maybe you've got no other income. Maybe you've got some losses carried forward as well that can offset that.
Yes.
Non-resident tax rates 0 to 135,000 is 30%. Then it goes up to 37, then up to 45 over 190. So with the new indexation method, they brought in a 30% floor. So effectively, if you do the indexation and your tax rate is less than 30% of the gain, then you get to uplift it to 30%.
Yeah.
But we're doing some little calculations, and it seems like they've obviously spent some time looking at this 30%.
Yeah. It's interesting because actually for expats and as a practical reality, in a weird way, this change is a bit more beneficial to us.
It is.
It's a bit hard for people in Australia. So, if you previously sold an asset, you would be able to claim a 50% discount on the capital gain that you've made on that asset. That's what's being replaced in Australia. Obviously, in Australia, you have different marginal tax rates, including a tax-free threshold as well. So the fact that they're instituting a 30% floor is going to affect people living in Australia a lot more. Yeah. For us overseas, and maybe I'll kind of put it down into my layman understanding, right? At the moment, for us, we don't get any capital gains discounts at all. So the entire amount of gain that we get is taxed at the non-resident tax rates, which
Correct.
are, like you said, are between 30 to 45%.
Yeah.
So quite significant. What is going to happen for us is we'll actually be able to increase the cost base that we have when we purchase the asset over time.
Yep.
So what that means is, say, I've purchased a property today, I sell it in 5 years. The way the rules were before the budget, we have the start cost price at today, the sale price at 5 years. That entire period, every gain over that 5 years was fully taxable before. What will happen from now is the purchase price today, that price or that cost base will incrementally increase over the next few years based on level of inflation.
Yeah.
So the gap between the cost base and the sale price, what we call the gain, is actually going to reduce on paper over time, and the actual tax calculation should be less than what it would have been previously.
Yeah, spot on. And over a 5-year period, you could even say, let's say 2.5% per year, just to pick a number. Your inflation adjusted amount would be something like 1.13 or thereabouts, right? So, with a few ups and downs, that was just some numbers I was playing with some other people. So, to give you an idea of what that uplift might look at. Now, importantly, because of their push on new housing, new properties are exempted from, new properties not exempted, but you get the option to choose between your CGT method with the new properties. So effectively meaning if you buy, and a new property, like I said, it's got to be like a new supply to the market, can't be knocked down, rebuild. So at the time of sale, providing it's post 1 July 2027, you can pick either the discount method or you can pick the indexation method.
Do we know if that applies to non-tax residents? I'm assuming not, but yeah.
Yeah, look, there's all the commentary I'm reading says that applies to non-residents, but you don't get the discount. So effectively, non-resident, you're going to pick no discount, or you're going to pick
something.
Yeah, something which is indexation. Hard decision. But anyway, so that's an option there. The bigger question is, how do you deal with the changing over of the two periods? So the HO's come back and said either a market valuation. So if it's shares, it's easy. You just look up the market valuation. If it's property, you need to get a a property valuation at that point. So, 1 July 2027.
So for those of us that are expats that have existing property, we should be thinking about getting a valuation in July next year. Okay.
Yeah, and look, with the valuations, there's nothing urgent about having to get the valuation on that date because there's plenty of valuers that can give you a historical valuation.
Yes.
Because there's plenty of data on the internet. There's nothing suspicious about it. ATO accepts it, etc. So, valuations is fine. So no one panicking on the 1st of July going, oh my God, we need to call someone and work out how much our property's worth.
An influx of requests on one day.
Yeah. So, and the ATO also say they're going to have some sort of apportionment method, which will probably be some sort of day count. So maybe there'll be 2 methods you can choose from, and you can sort of get the valuation, decide whether you want to use it or not.
Yeah. Well, the other big question I'm getting, and I don't know if we have a firm answer yet, but will the indexation method, is it only going to apply from the 1st of July, or are we going to retrospectively be able to use that? So if I bought a property 5 years ago, does it start from the day that I purchased it 5 years ago, or only from the 1st of July 2027?
Yeah, only from the 1st of July 2027, everything I'm reading. So
everything previous to that would still be basically fully taxable? Or the gain would be fully taxable?
Discount method with 0 discount, basically. Yeah. So, yeah, exactly. So that's it. So there's, as people have been joking, I'm going to be... tax accountants are going to benefit from this because suddenly, life gets a lot more complicated and we get a bit more work. So, I'm all right with that.
You need a brand new calculator for this.
Exactly. Exactly. I'm worried about AI taking my job. It may still take my job, but I'm doing my best to make sure it doesn't.
I guess, with capital gains, anything else anyone should know?
So, the pre-85 one's an interesting one. So, And to be honest, I don't actually have any clients that have pre-85 properties, but capital gains tax was introduced in 1985.
Yes.
Effectively from 1 July 2027, as in your pre-85 properties will then be subject to the indexation method. So there's kind of like, there's no exemptions there. So if there is anyone holding a pre-1985 investment property, not primary residence, but investment property, the advice would probably be to sell the property before that date, or you need to kind of work out what the tax calculation would look like. But, if you're going from completely tax-free property to taxable property, you probably want to sell it. That's, that's there. So that's obviously a push to make that change kind of thing.
Yes.
Yeah.
And the only last question I can think of that I got was, is the 6-year primary residence exemption still going to be applicable for people? And that would practically be, we have some clients that move overseas, but then move back home into their property in the 6-year period. Are they still able to claim?
So just for those that aren't aware of the 6-year period, it's buy a home in Australia, move into it, establish as a principal place of residence. That can be a short period of 3 to 6 months or longer.
Yes.
Then you move offshore, and the ATO gives you up to 6 years that you can generate assessable income from it, or longer if you're happy to pro-rata. No changes to that. Really important with the 6-year exemption, have to be an Australian tax resident when you sell it.
Yes.
That's really important when the contract is signed.
Yes,
so
you have to be back.
So don't sell that when you're overseas. If it's got a principal place of residence exemption too, it'll be disaster.
Yes.
Yep.
Cool. Great. Negative gearing.
Negative gearing, yes. Oh, now Tim, sorry to go to backtrack. Self-managed super funds are not affected by the change as well in CGT as well. So something to know as well. So, but yes, negative gearing.
Yes.
Yeah. So what's changed? So, so we're removing. Also, the government, not we.
You're not that mean.
You wouldn't do that, Tim. The government is removing the ability to negative gear investment properties from 1 July 2027.
That's established investment properties.
Yeah. So what does that mean? So that means that properties that you've got today, so any listeners that would have investment properties, no changes with those properties. So even though they're established properties, no changes with those because you've owned them on budget nights. That was the cutoff date for that.
Yes.
Means that they've still got the ability to negative gear, and negative gear is using the losses that are generated from that property to offset salary and wages. So no changes to existing properties. Newly purchased established properties, so you might call it a second-hand property, purchased from budget night onwards. You're only going to be able to use negative gearing up until 30 June 2027.
So 2026, right? Since 1st of July 2027.
No. For the 30 June 2027 financial year is the... 30 June 2027 financial year is the last year you can use the negative gearing.
Okay.
And then from 1 July 2027, so from the 2028 financial year onwards.
Sorry,
2028 year onwards.
See, my date's
Then,
confused already.
it's all right. I keep wanting to say 17. I keep getting corrected. So, anyway. From 1 July 2027 onwards, if you have an investment property that's established that you purchased after that date, then you'll have to quarantine your losses to be offset against future property gains in the future. So, and that would mean offsetting other positively geared investment properties or capital gains. So, not a disaster, but it does change the strategy for a lot of people. And a lot of people, got these investment properties for that reason because they need to, give themselves a better tax outcome. So
when they go back home.
When they go back home. So existing properties untouched. So that's really good. By existing I mean properties you've owned on budget night.
Yes.
And again, they've exempted newly built properties. So this is more to increase the supply of newly built properties. So if you buy a newly built property from today onwards, you can still use the negative gearing losses.
Yes.
So that's another little push in the housing, and apparently it's to create a level playing field for new home buyers, so they're not competing against investors when they're going to buy an established property.
Yes. Yeah. So I think just to clarify a couple of points again that we're getting questions from people about, negative gearing is still around, but it's just been limited. So the main limitation is from budget night onwards, if you have purchased an established property, you can still claim negative gearing, but you can only use that negative gearing against other property income. And that would be rental income or capital gains income. So from 1st July 2027, you won't be able to use any of that negative gearing loss against any other income in your tax return, which could be other investment income or
salary wages,
income, other distributions, whatever.
Trust distributions, etc.
Yes. One important thing, though, is for residents, you can still borrow against you can still borrow for other investable purposes, and you can actually, you'd be able to use negative gearing against, say, shares.
You can, exactly, yeah. So really good point.
Only established property that has been limited.
This is just a property change, unlike the capital gains tax changes, which apply to all property assets. A couple of other carve-outs to mention. So commercial properties are untouched as well, so you can still negative gear commercial properties, and self-managed super funds also untouched.
Yes,
but obviously that would be limited in the self-managed superannuation environment. So it's not like you can distribute a loss from the self-managed super fund to benefit you personally, but it can help offset your other investments.
But I think that it'll be interesting to see what happens in the investment space and in investment markets too, because if you're able to claim that negative gearing loss against, say you've got a lot of equity in your investment property and you don't want to have to buy a new property, you want to put money into the market, it's going to be another way to actually get some negative gearing.
Take out the equity and use it for something else. Thinking of myself as a property investor, and you're also a property investor too, Tim. I'm not going to sell my property now. I'm going to hang on to it for a long time. It's you're probably the same too. So I wonder if that's going to be the mentality. I'm obviously not going to be out there bidding for another second-hand investment property, but my existing one, I'm going to hang on to it.
Yeah. So, depends on your outlook as well. I think, again, if you're a long-term expat, you don't really have any plans to go back in the immediate or, medium-term future. Actually, not really much of a change anyway, because all the losses you were accruing, they're probably going to be used against the capital gain in the future when you sell it.
Yeah,
anyway,
exactly.
So
they continue to accrue. There's no changes to the loss accruing rules, so you can still build up a big bucket of losses here in expat land, and then take it back to Australia and use it against the future capital gain or future salary and wages. You can still do go back to Australia, do the PAYG variation. So when you're working for someone, you can get that get the ATO to vary down your salary, so you can receive your salary Singapore style. So 100% of the bank rather than less pay-as-you-go withholding.
Yes, it's the thing that stings most for a lot of people when they go back. Is they get their first payslip.
They're like, oh, what happened? It's like, where'd my money go? Exactly. Yep, that's it.
But otherwise, the negative gearing aspect is still there for new properties that are being built. So it'll be interesting to see how things pivot over the next 12 months as well, and what the new build market looks like. Over
exactly. To see if there's a lot of developers that get excited about it. That's I'm very interested to see what happens to the property market in the next 12 months. To be honest, thinking about my own preferences and then trying to think about what all my clients and friends are thinking about.
It's some of the conversations I've had so far have been people want to see where things land. I think in the next few weeks, so it's just put a bit more uncertainty in the short term.
That's I guess that's it. Actually, is have you had many people that put their sort of plans on hold? Or was it sort of too soon?
There's still some look. They're looking, but I think the big question again in the immediate kind of few weeks, we're talking a very short term period here. Is they going to have some heat taken out of the market, or are they going to get some good deals for it?
Yep.
I don't know. We'll see what the next few weeks looks like.
Yeah.
When you're here next time, we'll shoot the next podcast.
We do. We will. Yes.
Do a reflection.
Yes. Exactly. Yeah. What do you think? Yeah.
I still think it's going to be interesting to see what happens, what actually lands out of all of this. Because again, the narratives in the news, pretty direct.
Yes.
At the moment, at the Treasurer and the PM.
They are. Yeah.
The last thing I just want to do a deep dive on is just the trust changes because it does impact a lot of our clients because a lot of people have had trusts before they've left. And it is tricky to borrow in a trust when you go offshore, but it's not impossible. And we do have quite a few clients that still like to do it.
We do actually have it. Like collectively, we've got quite a few clients that do have trusts. So
and also we have a lot of people that have gone home and set up trusts as well. So
common vehicle.
Again, maybe just talk. I'll let you just go through some of the specifics of the changes, and then we can just break it down.
So specific to the trust changes, so from 1 July 2027, so for the 30 June 2028 financial year, so trusts will then, if they're distributing income, they have to withhold a non-refundable 30% withholding tax, on the distribution. So effectively, the trust will have its own tax assessment. It needs to be paid by the trustee, and that tax credit gets passed down to the beneficiary. So the beneficiary can use that 30% to offset their actual real tax bill, but if there's leftover, can't refund it. So the main the commentary around the main sort of gaps they're closing there is mum and dad trusts that are distributing to adult kids that are at university that aren't earning any money, so you can give them sort of $20,000 without having to pay any tax. Now that $20,000 is going to have a 30% withholding tax applicable to it. So suddenly the kids are not as interesting as they used to be for tax purposes. That is, and also to close that gap of being able to distribute to like non-working people to spread the income out. So if you've got a non-working spouse, or you've got even like a parent, like a retired parent, self-funded retiree parents they're not receiving any kind of Aussie benefits, so it doesn't affect any income tests. That's gonna close that loophole as well. So a lot of people are likening the trust now to a company because 30% tax rate. So it's not applicable to unit trust, so it's just discretionary trust. That's important. So unit trust is obviously a fixed trust.
Fixed holding unit trust.
Fixed holding unit trust, and self-managed super funds not available to them as well. Deceased estate charitable trust. So companies are now kind of back on the table as an interesting vehicle to consider, especially because companies in the past were not an attractive vehicle because they miss out on the 50% capital gains tax discount. So now suddenly the company might be a little bit more interesting. I guess the question is, does the company get indexation? I'm not sure about that one. But
I think, again, Devil's going to be in some of the details that comes out in the next few weeks. But we were at an event last night, and this was one of the big questions that we got was around, okay, people were using trusts for income splitting. Now, is it going to be more beneficial to put things under a company instead? Because you still got the 30% tax, but at least if you distribute money from a company as a dividend, you actually get a franking credit.
You do, and the franking credit is refundable.
Correct, whereas the trust withholding tax credit is not refundable. It's a minimum 30% that you have to pay.
Exactly.
And it might just be, I guess if I think about it in a family situation, and again, none of this is formal advice. So
yes, exactly. Not formal, get your own advice. Just consider your own circumstances.
But if you, kids can be shareholders, or is there a minimum legal age for them to be?
No, that's an interesting one, actually. Okay, so I do a lot of work with one particular company, and Jenny Hamley is my godmother of all things company. So she's advised me they sort of can, but can't. So I know that sort of...
Again, you probably have to be very careful.
I think it's a careful one. So I think largely speaking, probably can't be shareholders. So you'd have to wait until they're adults before you give them shares in your company. And there's a few extra things to consider if you're giving someone shares in a company rather than making them a beneficiary of your trust.
Yeah, interesting. Anything else on trusts?
No, that's kind of the main piece on trusts.
Mm-hmm.
There's definitely a deeper dive to be had on the trusts with trust strategies. So
Yes.
obviously with Aussies and Aussie businesses and Aussie Aussie active kind of investment trusts that are distributing income on a broader piece, there's probably a much deeper dive that we can have there. But is it relevant to this audience? Maybe not. If we're saying, okay, if you've got an existing trust, should you do anything now?
Yes.
The tricky thing about doing something with the trust is if you've got a property in the trust and you want to exit that property from the trust, you've got capital gains tax, you've also got stamp duty. So, it's going to be a case of, the government's talking about having the ability to restructure your trusts. I don't think the restructuring is going to apply to trusts that have got existing properties in it. So, it's probably, maybe reconsider your next purchase through a trust, but existing trusts, keep them as is. They can still have the properties in them. They can still accrue those losses if you've got a loss-making property in that trust. So there's no changes there.
Okay.
And look, to be honest, when you sell the property, you're probably going to make a capital gain and you're probably going to pay more than 30% tax anyway on it, potentially. So, it may not affect your current strategy.
I've got 2 questions for you on the trust stuff.
Yeah.
So the first one is, can you easily convert a discretionary trust into a unit trust? Or is it effectively a brand new deed and a transfer?
Yeah, it's brand new, unfortunately.
Purposes?
It's just like a brand new entity. So, there's no... Someone asked me this the other day, actually, and my CorpSec people came back and said, no way. I was like, all right.
Absolutely not.
Yeah, absolutely not. Yeah.
Another common structure that a lot of our clients use is you'll have the trust that will distribute to a corporate beneficiary, and then the corporate beneficiary will pay a dividend or disperse funds to the shareholders.
Yep.
Do they effectively mean that they don't? Is that like a way to wash out the withholding tax credit, or is it going to flow through still to the shareholder?
Yeah. Okay. So
maybe that's too technical for today.
From what I'm reading. So if you've got, for example, the other way around, if you've got a company paying dividends into the trust, so you've got franking credits built up. I know I've definitely read that those franking credits can help offset that 30% tax. So whatever the tax that's coming out, if you've got 25,000 worth of, or 25% worth of franking credits, but you've got a 30% withholding, then the tax bill at the trust level is only 5% to top it up. But it still kind of rebrands it as non-refundable when it distributes out to the...
Yeah. I think the main message for this is if you have a trust and you want to understand what it means for you, then talk to Tristan.
About it. Thank you, Tim. Yeah, let's have a chat.
It gets a bit complicated.
Yeah, it gets complicated. Yeah, exactly. Yeah.
Any other parts of the budget that caught your interest? There's 2 on my mind because they're the 2 that are also getting the most headlines.
Yeah, I guess a small one to touch on. A lot of Aussies returning to Australia are always interested in hey, what can I do with my car, right?
Yeah,
so if we're talking about sort of, there's currently a fringe benefits tax exemption on electric vehicles. So effectively you can salary package them. You get a full tax deduction for the cost of the car. It reduces your taxable income. So it's like a permanent tax deduction, pretty good. They're phasing that out. So I think that's a progressive phase out for the next couple of years. And then after that, you're going to get effectively 25% discount on your fringe benefits tax bill. So that, EV concession is still around. I'm looking at getting an EV because I think, tax-free cars are pretty good. So definitely something to consider. And I think the government recognises it's something a lot of people jumped on, so they want to keep doing it.
Yeah, okay. Yeah. Great.
Yeah.
One I keep seeing in the news is around the personal tax credit of $250 or something.
Yeah, tax offset. So that's just it's just a tax offset that will kick into gear and come tax return time. So it'll give you just a $250 discount on your tax bill. So it's a little bit of don't have to do anything for that one. Obviously not applicable to expats, sadly.
No.
Yeah. Sorry, everyone.
The other one I've seen a bit of noise about is the instant asset write-off for small business as well. So that's been a measure in the past few years that was temporary, but it kept getting extended every year, right? And essentially it means if you purchase an asset under a small business, you can write off the whole value in that one tax year instead of depreciating it over 5 years.
Yeah, which is nice for it just kind of helps a lot of businesses. Yes. It's only 20,000, but it's 20,000 per asset. So
get a few computers a year.
Exactly. Yeah, for those people with businesses with cars, unfortunately, it's hard to get a car for less than $20,000. It doesn't apply to the first $20,000 either. So it's just there's got to be a complete asset for less than 20,000. Yeah,
okay.
less than 20,000.
Good to know. But basically, they've made that a permanent measure in the budget now, so there's no more expiry date.
Correct. Yeah,
forward.
exactly. Yeah,
Okay.
exactly. Which is a nice small business concession.
Yes.
Yeah.
Yep.
Yep.
One question I've also been getting on the borrowing side and the expat side is what's going to happen to borrowing assessments now that there will be an expiry date for negative gearing on established property. The short answer is we don't know exactly yet. The banks are relatively savvy with this stuff. So at the moment, for expats, it doesn't have much of a difference because they don't let us use negative gearing in our assessments anyway. But if you're living in Australia, 100% negative gearing does have an impact on your ability to borrow. My suspicion, and again, just putting it out to the universe at the moment, we don't know for sure, but the banks will probably ask us as brokers to confirm the date of acquisition on the property and was it established or new at the time of purchase, and they'll put that into their calculations going forward. So wait and see.
I guess in my opinion, the banks obviously want to try and do the business right, so they're gonna try and keep it's a competitive landscape.
Yeah, I think they'll also take the lead from what the regulator says.
Yeah,
as well.
Yeah,
so,
that's true. That's true.
So yeah, I think we'll just wait and see what happens at the moment. Any existing approvals are good at the moment. So.
Yes, nice. Don't panic.
No, that's the main thing.
Got the existing approval. Don't panic.
A lot of people were panicking yesterday, and maybe a few today. But a lot of these things we just need to take a breath sometimes. Actually, for expats, if you think about the overall changes, it's not going to have a big impact on us right now. And actually, the indexation method will end up being a benefit to us over time.
Yeah, it'll be benefit. Well. You look at the other changes. No changes to existing properties. That's good. Any last minute restructuring needs to be done. No, and it's more just have a think about your next purchase structure.
Correct.
What you're going to do, like the class of property. That's really important. So if you're buying, if you are going to buy an existing property because you don't want a new build, it's more just having a think about those losses. Can you use them in the future against the capital gains? And the answer is probably yes. Probably can use it against the capital gains in the future, so it's not the end of the world.
Exactly. And I think, if you want to think about investing and, investing in property, tax is one part of the equation, right? You've still got to have a real think about why am I investing in this asset class? And the reality is Australia still has not enough supply. We still have supply constraints. We're still not building enough properties. So if you're buying an asset as an established property, all likelihood, depending on where you buy in the country, but it's still going to have very, decent price growth over the next few years. There's still going to have decent rental growth as well.
We've still got a housing shortage.
If you were going to, if you're going to go back and invest, you've got to think about the fundamentals of why you're investing. And actually, all of those fundamentals are still there. It's just, there's a small amendment to some of the tax changes, but especially for us over here, it's actually not that big of a change.
Yeah, agree.
And you're still able to claim losses against the future property income, which capital gains is the biggest one. As well.
Correct.
So, great. Anything else?
Nice. No, Tristan, that's always appreciate the opportunity to come and have a chat with you about tax. Tim.
We appreciate it as well. It's it's like I said, it's always good to break it down because there's a lot of headlines, a lot of people talking.
Yeah, and look at the next time I'm up, we'll definitely have another podcast and we can talk about life post the budget. See if anything's changed, and we even have a deeper dive into trust strategies because by then I think I'm looking forward to getting back to Oz to see what all the Aussie-based tax advisors are talking about on kind of restructuring assets. So. No doubt I'll have some more to share with yourself and the listeners on some strategies that are popping up.
Yeah, definitely. We look forward to hearing them.
Yeah, cool. Thanks. Cool.
Thanks so much. We'll see you next time.
Thank you.